Welcome to today's deep dive into market sentiment and funding rates. I'm Jim Cramer, and we're going to break down what a decreasing funding rate means for traders and investors. You see that ticker there? That's the market, folks, and it's driven by forces you need to understand deeply. Funding rates, they're like the hidden currents in the vast ocean of trading. They can tell us which way the tide of sentiment is turning and why. We're going to crack this code wide open, so buckle up and stay tuned. Now, when we see a funding rate heading south, it's like a big, flashing neon sign screaming, "Bears are in control." That's right. A decreasing funding rate often means that short positions are ruling the roost. It's a clear indication that the market sentiment is leaning heavily towards the bearish side. It's a showdown, folks, bulls versus bears, and the bears are winning. Think about it. When the funding rate drops, it means those betting against the market, the short sellers, are paying those who are long. They're literally paying to keep their bearish bets alive. Why? Because they're convinced the price is going down, and they're willing to put their money where their mouth is. This kind of bearish sentiment usually pops up when traders smell trouble on the horizon. Maybe they're seeing weakness in the fundamentals, or maybe there's fear and uncertainty in the air. Whatever the reason, a decreasing funding rate is a clear signal that traders are bracing for a potential downturn. It's a sign that the market is preparing for a rough patch ahead. Remember, this isn't just some abstract concept, this is real money on the line. And these traders, they're not in the business of losing money. They're reading the tea leaves, looking for any edge they can get. And when they see a decreasing funding rate, it's telling them to buckle up, because a wild ride might be just around the corner. So, don't ignore this crucial indicator. When the funding rate starts to dip, pay attention. It could be the market whispering a warning, telling you to tighten your seatbelt and get ready for a bumpy ride. The funding rate is a vital piece of the puzzle in understanding market sentiment. It's a barometer of trader confidence and market direction. So next time you see it heading south, remember, it's not just a number, it's a signal, a warning, and a call to action. Stay alert, stay informed, and always be ready to adapt to the ever-changing market conditions. Now let's talk leverage, folks. It's a term that gets thrown around a lot in trading circles, but what does it really mean? Leverage is like rocket fuel for traders. It can propel your investments to new heights, giving you the power to control larger positions with a relatively small amount of capital. However, it's a double-edged sword. It can amplify your gains, but it can also magnify your losses, making it a risky tool if not used wisely. And when it comes to funding rates, a decline can tell us a lot about how much leverage is being used in the market. Funding rates are essentially the cost of holding a leveraged position. See, when the funding rate is high and mighty, it's like a green light for leveraged longs. Traders are more willing to take on risk, betting on a rising market. They're piling into trades, using borrowed money to supercharge their bets on a rising market. This can create a feedback loop, driving prices even higher. But when that funding rate starts to dwindle, it's like someone's hitting the brakes. Traders become more cautious, and the appetite for risk diminishes. A decreasing funding rate suggests that fewer traders are willing to go all in on leveraged long positions. This can lead to a reduction in market activity. They're getting cautious, maybe even a little bit spooked. The fear of potential losses starts to outweigh the lure of big gains. This reduction in leveraged buying can take the wind out of the market's sails, leading to a slowdown in momentum. The market can start to lose its upward drive. Think of it like a party. When the music's pumping and the drinks are flowing, everyone wants to dance. The energy is high and the excitement is palpable. But as the night wears on and the music starts to fade, people start heading for the exits. The enthusiasm wanes and the crowd thins out. The same thing can happen in the market. When the funding rate drops, some of that speculative fervor can evaporate, leaving the market vulnerable to a pullback. The volatility can increase, and the market can become more unpredictable. Traders may start to exit their positions to avoid potential losses. When the funding rate drops, some of that speculative fervor can evaporate, leaving the market vulnerable to a pullback. It's a signal that the market's risk appetite is changing. So keep a close eye on that funding rate. It's a crucial indicator of market sentiment and can provide valuable insights into potential market movements. If it's heading south, it could be a sign that the leveraged long party is winding down. Traders may start to pull back, reducing their exposure to risk. And when the music stops, you don't want to be the last one left holding the bag. Always be prepared to adjust your strategy based on market conditions. Now here's where things get really interesting. We're diving into the world of funding rates and their potential to signal market reversals. Sometimes, a decreasing funding rate can be a contrarian indicator, especially when it plunges into negative territory. That's right, negative. This can be a crucial moment for traders. It sounds crazy, but it happens. And when it does, it can create a unique trading opportunity. Imagine this. The funding rate is so deeply negative that short sellers are essentially paying long holders to keep their positions open. This scenario can be quite rare but impactful. It's like giving away free money, and who wouldn't want to take advantage of that? This extreme situation can signal that bearish sentiment has reached a fever pitch, potentially setting the stage for a short squeeze. This is where things can get really exciting. Think of it like a coiled spring. The more pressure that's applied, the more explosive the release. The more negative the funding rate gets, the tighter that spring becomes. It's a buildup of potential energy. And when it finally snaps, watch out. The market can move rapidly and dramatically. Short sellers caught in a vice are forced to buy back their positions, pushing the price higher and creating a frenzy of buying. This can lead to a rapid price increase. But hold on, it's not always that simple. There are nuances to consider. A decreasing funding rate can also signal a cooling off period after a period of intense bullish euphoria. This is a natural part of market cycles. Remember, what goes up must come down. Markets are cyclical and corrections are inevitable. If the funding rate was sky high before the drop, it could just be a sign that the market is taking a breather. This is often a healthy sign. So how do you tell the difference between a bearish signal and a potential reversal? Look at the context. Context is key in these situations. Consider the overall market sentiment, recent price action, and other technical indicators. These factors together can provide a clearer picture. A deeply negative funding rate, especially after a prolonged downtrend, could be a sign that the bears are overplaying their hand. This could indicate a potential reversal, but a moderate decrease after a parabolic rally might just be a healthy correction. It's important to differentiate between the two scenarios. So, there you have it. A decreasing funding rate can tell us a lot about market sentiment, from bearish dominance to potential reversals. Keep these insights in mind as you navigate the markets. Remember, knowledge is power. Don't be caught off guard by shifting funding rates. Stay informed, analyze the data, and use it to your advantage. The market is a battlefield, and information is your weapon. I'm Jim Cramer, and thanks for watching. Stay informed and trade smartly.